Today, we are strapping in for a really high octane analysis of one of the market's biggest recent moves. I'm talking about Chevron, ticker CVX. The news has just been, well, dramatic. This energy giant completely exploded past that critical $155 level. It surged over 2.2% in just one session, and it closed right at its daily high. Okay, let's unpack this. We've got an analysis report right here that suggests this breakout isn't just some technical blip on a chart. It's pointing to a foundational shift, something fueled by surging institutional bullish sentiment. So our mission today is to really dissect this report. We're going deep on the price action, the fundamentals behind it, and that analyst forecast that's pointing all the way up to $176. The analysis literally calls this the oil giant waking up.
And that's such a key phrase. This is more than just a simple stock rally, and it's really significant for you to understand why this matters. We're using this report to basically decode what the big institutional money is prioritizing right now, because when an established, a behemoth like Chevron starts moving with this kind of conviction, it signals a major potential reallocation of capital. It's a move toward value, toward stability, and controlled growth. So we have to look at the arguments in the source material that justify calling this a major breakout.
Absolutely. So let's start at the beginning. The spark. That immediate, decisive move on the chart. The stock closed at $155.90. That's a gain of almost $3.50 in a single day. And that sounds impressive on its own, but the real story, as you said, is in the shape of that move.
It absolutely is. I mean, if you look at the intraday chart action described in the report, it just speaks volumes about conviction. The stock actually, it tried to test its lower supports early in the day, which suggests there was some, lingering skepticism, maybe some profit taking, but then it completely reversed course. It executed what the technicians call a powerful V-shaped recovery. It didn't just regain the losses, it accelerated right through the previous day's close.
And here's where it gets really interesting. And this is the detail that the analysis says confirms that institutional thesis, the close. That $155.90, it wasn't just a good close. It was the exact high of the day. And for a long time, that $155 level had been a ceiling, a real psychological barrier.
That is the crucial institutional signal. It's everything. The analysis just synthesizes this perfectly. It concludes that this specific action indicates institutional money was buying right up until the final second. It showed, and I'm quoting here, zero hesitation to pay the highest price of the entire session.
Okay, but let me play devil's advocate here for a minute. Isn't that sometimes just, a bit of momentum chasing, or maybe some end-of-day window dressing by funds? Why does the analysis attach such deep significance to that specific $155.90 SAC closing price?
That's a fair question, but it comes down to the implied volume. It's not just price. The report noted that this V-shaped recovery wasn't on a thin market, not at all. It was confirmed by a volume spike that was, get this, 40% above the 50-day moving average right as it broke above $155. High volume on a breakout, closing at the absolute high. I mean, that means there was a major unmet appetite for the shares. The big players are now seeing $155 not as resistance, but as the new floor. It's a launch pad.
So if the stock action is confirming this breakout with real teeth, that means the immediate short-term conviction is strong. What does that buying behavior tell you, the listener, about the immediate market sentiment? It tells us that major capital is suddenly viewing stability and value in the energy sector as underpriced.
Exactly. It moves the whole narrative from just a technical thing you see on a chart to a real strategic shift. If the price action is the symptom, we need to understand the underlying health of the company.
Which brings us perfectly to our second section, the fuel. We need to move from that explosive chart action to the core fundamentals the analysis report cites as fueling this long-term bullish view. Because it's not a technical fluke.
Yeah.
It's a value proposition that is suddenly too attractive to ignore.
Absolutely. And the first most compelling point the report makes is what they frame as the cash machine dividend. This is really the cornerstone of the whole defensive argument for Chevron. The dividend yield is substantial. We're talking 4.39%.
That yield is definitely high, especially when you compare it to the S&P 500 average. But let's challenge this idea of a golden safety net, as the report calls it. A yield that's almost 4.5%, sometimes that can be a red flag, right? A sign of skepticism. Like, investors are demanding a high payout because they doubt the stock's going to go up.
Yeah.
Why is the analysis so bullish on this being a positive signal?
Yeah, that's a really important distinction to make. In a, let's say, a low interest rate world, a 4.39% yield might indeed signal risk. But in the current environment, with inflation still sticky and bond yields all over the place, the report argues it's a superior source of income, especially when you see it's backed by Chevron's immense free cash flow. This isn't some speculative yield from a shaky company. This is consistent income from a company with a fortress balance sheet. For an institutional investor trying to get consistent returns in a volatile market, getting paid nearly 4.5% just to hold a stable giant, that's a massive defensive asset.
Right, so you're getting compensated pretty robustly while you wait for that capital appreciation. But for growth investors, Chevron still needs to be reasonably priced for that appreciation to happen. And the analysis report does address this. It points to the valuation, citing a PE ratio of 22.
And that PE of 22 is just crucial context for the whole value thesis. The report explicitly positions this as reasonably priced compared to the broader tech-heavy market. It's an immediate contrast. You see these high-flying tech names trading at 40x, 50x earnings, and then there's Chevron. It's trading at a level that suggests both stability and, underlying profitability are still available at a fair price.
Okay, but let's go a little deeper than just the PE ratio. Energy investors often prefer metrics like enterprise value to EBITDA, right? Because of all the debt in the sector. Does the analysis report get into why, even with those other metrics, Chevron still looks like a value play?
It does, but more implicitly through its discussion of cash flow discipline. Chevron's EBITDA is certainly lower than many of its tech peers, but the real value story is in their ability to keep capital expenditures low while maximizing production. The report's thesis suggests that the current valuation is basically discounting the efficiency gains they've made. This means that PE of 22 is likely to get smaller as their earnings grow without needing massive new investment, and that's the very definition of an appealing value play, buying quality earnings before the rest of the market fully gets it.
All right, now let's tackle the old critique, the one you always hear. This perception of big oil as just legacy producers with limited growth. How does the report directly counter that narrative and justify calling it a growth engine?
This is where the report gets very specific about Chevron's strategy. They're not just riding high oil prices, they're relying on operational excellence and really smart acquisitions. First, they cite the massive dominant footprint Chevron has in the Permian Basin. And this isn't old school oil, this is modern, high-volume, low-cost shale production.
The efficiency engine.
Exactly. Their Permian operations let them maintain one of the industry's lowest costs of supply. And that efficiency is critical. It means they can generate profit and sustain that huge dividend even if oil prices were to, say, take a moderate dip. This is their internal growth discipline on display.
And the second key factor you mentioned was strategic moves, specifically involving Hess. What's the critical advantage they gained from that acquisition?
If we connect this to the bigger picture, the Hess deal is fundamentally about long-term reserve replacement. It drastically increases Chevron's proven reserves. Specifically, it secures a major stake in the high-growth, high-margin deep-water assets off the coast of Guyana. So this isn't just buying another oil field. It's securing a multi-decade growth pipeline that completely changes their trajectory. It makes them resilient against the kind of reserve depletion challenges that a lot of older energy companies face.
So the argument is pretty compelling. You get the defensive strength of a nearly 4.5% dividend, a reasonable valuation compared to the rest of the market, and you get genuine growth drivers from the Permian and the Hess deal. It's a really robust case for a best of both worlds scenario.
Precisely. The report is framing CVX not as a simple commodity stock, but as a strategically managed, cash-generating company that is well-positioned for both income and long-term asset expansion.
That momentum and those fundamentals lead us right into Section 3, the forecast. What's the forward-looking number in this analysis that's driving all the current frenzy?
Wall Street analysts, on average, currently hold a price target right around $176. That is the number that is capturing everyone's attention. It's a significant vote of confidence.
And if we just do the quick math, the implied upside from that recent $155, close to the $176 target, that's roughly 13% upside, just in capital appreciation.
And as you said, that 13% is before you even factor in that generous 4.39% dividend yield. So the total potential return package, if they hit that target, is north of 17%. And that is a very, very attractive proposition for institutional funds that need defined, steady returns.
This is where we get to the so what of it all. The analysis suggests the entire market sentiment is shifting. Investors are waking up to the fact that the stability of established energy is now undervalued compared to more speculative growth sectors.
What's fascinating here is the reported reasoning behind that consensus target. As global energy demand starts to stabilize, moving away from the pandemic and the immediate geopolitical shocks, the analysis argues that smart money is actively shifting its allocation. They're moving towards stocks with fortress balance sheets like Chevron for both safety and growth potential. This really points to a larger macro theme of risk aversion. Stability is winning out right now.
I understand the theory, but let's bring in a risk the analysis might be, let's say, downplaying. That 13% upside to $176. It relies entirely on the stability of oil prices, right? If oil were to fall sharply, say below $70 a barrel, that free cash flow outlook tightens up and it puts pressure on that forecast, maybe even the dividend.
That is the necessary asterisk on the $176 target, you're right. It needs oil price stability, probably in that $75 to $85 range to hold. However, when we talk about a fortress balance sheet, we have to remember 2020. The report implies that unlike smaller, highly leveraged E&T companies that were facing bankruptcy when oil briefly went negative, Chevron has the sheer cash reserves to absorb a severe, even if temporary, downturn. And that financial resilience is a massive psychological buffer for institutional buyers. It makes them confident the company can hit that $176 target once things normalize.
That makes sense. So in a turbulent global environment, capital isn't just chasing the highest possible return, it's chasing the most reliable potential return. And Chevron is acting like a flight to quality destination because of that stability.
Exactly. The shift that's reflected in that $176 target isn't just about oil prices going up. It reflects the market finally acknowledging that Chevron's capital structure and internal growth strategies make it a premium asset in the energy sector.
Okay, let's bring this deep dive home. We've covered the explosive price action, the rock-solid fundamental thesis covering both income and growth, and the consensus forecast pointing all the way to $176 left.
So what does this all mean for you? The core finding from this analysis is clear. Chevron has smashed through that key $155 level. It's being driven by a powerful combination of aggressive technical momentum and that steady high income from the 4.39% yield. The analysis suggests the oil giant has woken up, and it's offering a blend of value and growth that's becoming impossible for big investors to ignore.
And to build on the final point of the analysis, which really contrasted the safety of Chevron with the more speculative growth in the tech sector, let's leave you with this final provocative thought. The report positions Chevron as the safe income-generating play with a defined upside, about a 17% total potential return. So given this very bullish argument for stability and income, what is the fundamental trade-off you need to prioritize? Or what shift do you need to make when balancing those high-growth investments, like the tech-heavy market, versus proven income and stability plays like this energy giant, in your own view of the market for the coming year?
That is the complex question you need to be actively asking yourself right now. Where do you want your dollars positioned for this next phase?
Thank you for joining us for this deep dive into Chevron's bullish ascent.
We'll catch you next time with the next market move worth unpacking.